Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. On the phone with us today is my good friend, Matt Geiger. Matt is the head of the MJG Capital Fund. Matt, welcome back to the program.
Thanks, Colin. Always good to be here with you. It's been a tough year for the market, as you know, but we're sticking to the script, and I know you guys are as well.
Yeah, it certainly has. I like to get you on at least twice a year because you put out a very detailed, usually 50 to 100-page semi-annual report for your fund. In it, you talk about not just the main holdings in your fund, but also your outlook on the market, and I find it to be quite informative. So first of all, how did you find it putting this one together? Must be quite a time-consuming process.
Thanks, Colin. Yeah, investors, if they want to read the report, can access it on mjgcapital.com. It was a tough letter to write. I really came into 2018 with high expectations. We're in the later stages of an economic cycle. We just went through a 4 or 5 year painful bear market. 2016 and 2017 were good years, and I was expecting more of the same this year. I described the year so far in the letter as a gut punch, and I think a lot of resource investors are feeling the same way. So despite the results, which weren't great, we were down 20% in the first half of the year, which is painful, but is really just a symptom of the broader weakness in the mining space. Reception to the letter was quite good. And, there's quite a few company-specific updates in there. I think I got 5 different pieces out on companies like Golden Valley Mines, Sama Resources, Excelsior Mining, Ardea Resources, and also some market-specific commentary as well on whether we're in a new mining bear market and where I see things going from here. So it was a good letter.
Well, you said that the reception to the letter was quite good, and that brings me to a point that I keep making as these stocks approach the levels of 2016, and this will lead into kind of our first talking point here. The reception around the mining market is totally different still than it was in the end of 2015. The financing market, which was non-existent then, I still find for the right deals is there. It wasn't there for anything back then, and the overall sentiment and just negativity I can't find to be even close. So that'll lead me into the first question, which is, are we entering another bear market, or are we in a bear market for mining?
No, I do not think that we're in a new mining bear market. Obviously, sentiment in the space, as you know, especially over the past 8 weeks, has turned very negative. And it's not a consensus yet, but people are starting to raise this question. But I feel pretty firmly that we are still in the broad-based hard asset bull market that began in January 2016. And I would view this weakness since February of 18 through the present day as more of a consolidation period before the next move higher versus the start of another protracted bear market. And I have a couple reasons for this. The first is just looking at the average length of past market cycles. And generally, you'll see that over the past 40 years, your average junior resource bull market will last for 47 months on average and will give you a roughly over 205% gain over that period. Well, if we did indeed start a new bear market in January of 2018, that means that the latest bull market, which would have lasted between January 2016 and January 2018, would have lasted only 25 months and would have resulted in only a 70% gain. And if that indeed was the bull market, then that would have been the shortest and weakest bull market in decades. And to me, that seems pretty unlikely. I think we're all believers that bull markets are the authors of the following bear market, and bear markets are the authors of the following bull market. And if you take that a step further, you can also look at the intensity and the duration of the last bear market and get a good idea of what the intensity and duration of the upcoming bull market will be. Obviously, this is not an exact science by any means, but the lack of exploration spending, the lack of development spending, just the carnage that the industry underwent between 2011 and 2015 leads me to believe that there's still more to go in this bull market. And I think we do have 1 to 2 dramatic up legs before we really see the next bear rear its head. And the second point, which you touched on briefly, is that senior miners are more than willing to deploy capital across the space. And we've seen that just in the past 90 days. This is in stark contrast to what we saw between 2011 and 2015, where the bigger producers were divesting assets, they were closing mines, they were entirely shutting down spending on exploration and development activities. But yeah, just in the past 90 days, we've seen a $1.3 billion takeover of Arizona mining by South 32. We've seen Lundin lodge a hostile bid for Nevsun mining, and that's their third different time this year they've tried to take over that asset, and they've finally gone hostile. We have the purchase of Galore Creek from NovaGold by Newmont, which was a bit of a curious transaction, but it had a hefty price tag nonetheless. You have Peregrine Diamonds, which is backed by the Friedland brothers, was taken over by De Beers, and that deal's not officially closed yet. There could be a higher offer, but we're getting closer towards looking like De Beers will ultimately take over Peregrine. Recently, you had Core's takeover of Northern Empire's properties and the Walker Lane Trend of Nevada. Core, as I'm sure you remember, also took over Klondike's mines earlier this year, so they've been very active in consolidating. And then in May, we also had Barrick's, $40 million strategic investment into Midas's Stibnite project in Idaho, so that Barrick could get a 20% foothold into that company. So to me, this is very encouraging. It shows that the higher quality development projects are absolutely on the radar of these bigger companies. I think we have more deals and more M&A in the offing. And as these takeovers continue and the higher quality late stage development projects start to run dry, I think you'll see this spending start to trickle down into the earlier stage discovery plays and even exploration, with particular focus on the prospect generation space. So, for these two reasons, the fact that if the bull market did end in January 2018, it would have been the shortest and weakest on record in 50 years. And the second reason, the fact that the big boys are still more than willing to deploy capital across the space, I'm thinking that this weakness we're seeing is not the start of a new bear market and is instead temporary and will be followed by a dramatic upleg.
Matt, let's kind of look at this through a different lens, and you're absolutely right. This would have been the shortest bull market. That comes after the longest bear market, so it makes no sense. But maybe the bull market never even started yet. Our mutual acquaintance and friend Jordan over at the Daily Gold has pointed out that back in 1999 and 2001, these stocks basically double bottomed with a nice bump in between, as well as the metals. So is it possible that this epic bull market is still to come, and we haven't really seen anything yet?
I'm pretty confident that we were certainly in a bull market in January 2016. I mean, you guys were fully involved at the space at the time, as were we, and the dramatic gains over the first 9 months of 2016 to me signaled that the bear market of 2011 through 2015 was officially over. I will agree that given the length and the severity of what we went through between 2011 and 2015, this is probably more of a U-shaped process. And, I'm not surprised that things didn't go straight up forever and that there's been, weakness really since August of 16 after that strong move. But I do believe that the bear market ended in January of 2016 just by virtue of the power of that move. And it really lifted the whole TSXV well above 20%, which is generally the threshold that indicates whether you're in a new bear or bull market.
Yeah, definitely hard to argue with there. So let's talk about where we are now and what's to come next. By 20% price decline metrics, we're in a bear market, but by everything else that we've just discussed, we're not. Do you expect that things are going to keep sliding down and consolidating, or are you getting the feeling that the turning point is right around the corner? And maybe talk about the risks to things continuing going down and what could cause them to pop up.
Yep. I mean, I believe that the turning point is coming pretty soon here. And I think it's going to be dramatic, and I think it's going to be V-shaped. There's no guarantees. None of us have a crystal ball. My expectation is that things will reverse, though, by the end of this year. As you mentioned, there are some near-term headwinds. And if we see this slide continue for another 4, 5, 6 months, I think the culprit will be squarely the U.S. dollar. I am not a U.S. dollar bull, but I do understand some of the trends in favor of the USD. Kind of the three main ones that come to mind are the fact that the Federal Reserve have really been on a crusade to hike interest rates since late 2015. Most developed nations have not followed suit yet, whether you're looking at Japan or across Europe, and that's leading to an increasing U.S. dollar strength. We have kind of a more recent phenomenon, which is China's purposeful devaluation of the yuan as a result of the recent trade wars. And they're doing that to benefit Chinese exporters at the expense of U.S. exporters. And that's lending further strength to King dollar and kind of exacerbating the strength that we've seen recently. And then you have the fact that Europe, even though I think this is way too high of a percentage, makes up 56% of the DXY, or the dollar index. So European currencies alone make up over half of the dollar index. And I believe that Europe remains a hot mess, unfortunately. And, between the continued Brexit drama in the UK, the rise of, as some would say, fascism in places like Hungary and Italy, I think there's more turbulence to come there. And that could lead to near-term strength in the USD. However, I would say that the US dollar also has some key factors working against it. And you haven't heard these, at least in the mainstream narrative, recently, but I think you'll hear this more and more. So the first is it comes down to political instability. That is never good for a currency. And looking at the U.S. right now, one thing that you can just say factually is that when a president takes power, generally in the next midterm election, you will see the opposite party, at the very least, win the House. That's what happened when Barack Obama won in 2008 with a landslide electoral victory. But just 2 years later, the House swung Republican. That's generally how it works. Right now, the markets are saying that there's a 67% chance that the Dems do take the House in the upcoming November 2018 election. So then you have to think to yourself, putting one's political beliefs aside, I think we can all agree that if you look at the Democrats, they do not like Trump. And they probably want to find an excuse to impeach him, to be perfectly honest. If the Dems do take control of the House, then I do think that there is a chance of there being impeachment talks as soon as next year. And certainly once Mueller delivers his final report on potential obstruction of justice, Russian collusion, or what have you. So again, I'm not taking a side on whether this is right or wrong. I'm just saying it is likely that the Dems will take the House. The Dems do not like Trump, and they're likely to try to take action if that's the case. So again, that's something against the U.S. dollar. Political instability is never helpful for a country's given currency. I think there's a second point that's critical as well. The U.S. fiscal situation is not all that strong. And again, we really have two parties here. One party is the Dems, who really could care less about the national debt, and that's a problem. There should be more of a focus. This is a serious issue. The second is the Republicans, who, to their credit, over the past 10 years, before they took power in 2016, talked constantly about the national debt and how it needed to be cut down. And I agree with that. However, since the Republicans came into power in late 2016 with the election of Trump and then them also winning the House and the Senate, they've controlled basically all levers of power in the government. And what do we have? We have a national debt that continues to climb at similar rates that it did under the Obama administration, and now a national budget deficit of $2 trillion per year. That's only been exacerbated by Trump's recent or by the tax cuts of last year. And there's a pretty staggering statistic. Recently, the IMF looked at 35 different developed countries, and they looked at the debt to GDP ratio over the next 5 years. And out of these 35 developed countries, the U.S. is the only one where the debt to GDP ratio is expected to rise over the next 5 years. So again, this is another thing. Worries about debt to GDP or worries about government debt, another negative for any underlying currency. And so I think that's a headwind against the US dollar that's going to gain some momentum. And the final point, which is really important, is that this is a freaking crowded trade. This is a very crowded trade at this point. On August 14th, if you looked at the DSI, which is the daily sentiment indicator, and that's a number that can range between 1 to 99, with 99 being extremely bullish and euphoric, and 1 being extremely negative and bearish. And on August 14th, so just last week, we saw the DSI at a 96% for the US dollar trade. That is extremely bullish, that means the market is extremely bullish. And in the 8,000 days that the DSI has had readings on the US dollar. That high of a rating has only occurred on 5 different days. So this is an extremely uh, this is a phenomenon that we've only seen 5 times over the past 8,000 days here. And while some of the strength behind the US dollar is real, I think the market has more than recognized that at this point. And it's really hard to get that final 4% to flip, and there's probably not much more to go.
So, Matt, we've got a few minutes left here. I just want to go over, and if people are interested, they can certainly read your full report because you really go into detail here. But considering where we are in the market, what are you looking for right now? Certainly things change when prices change, and certain stocks have been affected more than others right now. So where's the opportunity really lie as opposed to, say, 6 or 12 months back?
Well, for the mining space in particular, there's a few places I'd look. At the very top of the list are these quote unquote high quality development plays. Now, I know that's a bit of a generalization there, but these are really the names that these are phenomenal projects that have extraordinary 40% plus, 35% plus IRRs at current metal prices with high quality management teams behind them. And in good times, as in just a year ago or 6 months ago, these are the types of stories that trade at massive premiums to their peers, both due to the quality of the asset, quality of the people behind the story, the quality of the investor base, et cetera. But you've seen over the past 3 months or 4 months in particular, these names have sold off with the rest of the space. And so now is an opportunity to get involved with these higher quality names at pretty massive discounts to where they were recently. Some examples that come to mind, and we don't own any of these companies, at least at this moment, would be Regulus Resources, Entree Resources, Mag Silver, Alexco, Tinka, Ivanhoe. And again, these are all names from the past year that have phenomenal stories, seem to be creating substantial shareholder value. But again, we're trading at massive premiums for their peers, against their peers. And that is no longer the case. I think that's a great opportunity for investors to look at right now. I guess a second place would be the well-managed royalty plus streaming companies. And I'm particularly partial to the ones trading in the single digits from a price to cash flow multiple perspective. It's a really good environment for these companies because they're cash flowing still and should be able to ride out the bear times. That's a huge advantage of the royalty and streaming models. And additionally, this creates a good high quality window for deals and for value creative acquisitions here. So I expect to see the royalty companies getting busy, and it's market weakness to these CEOs makes them excited. And it's an opportunity to tack on some higher quality assets into the portfolio. So 2 names that fall into this category that we own that are trading with the price to cash flow multiple in the single digits would be Metalla and Input Capital. One we don't own but are looking at closely is a Sandstorm, particularly given the share price action there just over the past 2 weeks. That one's been absolutely whacked. But that's a high quality story. And if you subtract out the value of the Hod Maden 30% interest and the 2% NSR, we're talking about a company that's trading at a price to cash flow multiple of 9 to 10x. When you look at its bigger peers, like Franco or Wheaton, Precious Metals or Royal Gold, they're up in the 20x to 25x range. So there's some real exciting opportunities within the royalty and streaming space. And then, the third bucket I'd look into are opportunistic private placements. And you've heard this from me before, and you'll hear this from me again. In this environment where times are tough and there is a competition for capital, this is where investors need to ask for very owners' deal terms. And I'm talking no accelerator and a 3 to 5 year warrant. If investors are considering placements with these types of terms, they also want to make sure that management has ample skin in the game. And, I would define that as north of 10%. You really want to see management in double digits if you can. This is important because if you're getting a 3 to 5 year warrant, you want to make sure that management has enough incentive to stick around for 3 to 5 years and actually make the story work. And the biggest way to see if management is incentivized is through their insider ownership position. You also want to make sure that the company, if they're coming back to market to raise money, you want to make sure that they're raising enough where they don't have to come back for another placement for at least the next 12 months. We don't know how long this period of weakness will begin. As I mentioned earlier, I'm quite convinced that it's gonna turn pretty quickly here in the next few months. But out of safety, you want to make sure that the company is raising enough money where they have a runway of at least 12 months. And so, yeah, those are kind of the three areas I'd look at. The very high quality development plays that work at current metal prices, produce extraordinary IRRs, but generally aren't available at a discount. Here they are. The well-managed royalty and streaming names who seem to offer fundamental value, can make accretive acquisitions in the meantime, while weakness continues, and then we'll reap the benefits when things inevitably do turn. And then these opportunistic private placements with the full 3 to 5 year warrant, making sure that management's incentivized and making sure that they're raising enough money where they're not going to have to come back to market in a few months.
Excellent. Well, Matt, thank you for the time coming on today. And I get questions sometimes as to if Palisade helps on managing money. We absolutely do not do that. And one of the only people I know in the space who is able to take U.S. investors and invest in these junior resource stocks is Matt Geiger. You can tell from his interview right here that he's better researched than just about anybody else in the space. So I would suggest getting in touch with Matt, which I'm sure can be done by visiting his website. Matt will endeavor to get you back on the show here in the next few months following your call for a V-shaped bullish reversal.
Thank you, Colin. I understand I've stuck my neck out there a little bit, and let's touch base one way or another in these next few months, and we'll see how it goes. And as always, I appreciate the support. You guys have always been the MJG Fund's #1 fan. Website, again, is www.mjgcapital.com, and I appreciate the time today. We'll talk soon.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?